The next one is to Dan. Dan, I know we've talked about this before. And the question here is, didn't the economists assure us that a scenario similar to the Great Depression could not reoccur? Can you put this in perspective? Are we better off than where we were in the 29 and 30? And how is it better?
Yeah, so the knee-jerk reaction, anytime somebody says, is this going to be like the Great Depression? My knee-jerk reaction is always, of course not. It's not going to happen. And this time, I reflected on it a little bit more. Is it really not going to happen? And I still think that it won't happen. And here's why. In 1929, from basically 1929 to 1932, what was the government's plan? There was no plan, okay? What did the Federal Reserve do? The Federal Reserve tightened the money supply, okay? The Federal Reserve was worried about inflation and didn't want to make any liquidity available. So basically, as economist Milton Friedman especially went back and looked at some of the causes of the Great Depression and basically said one of the reasons it was so bad was because of the actions of the Federal Reserve were just so contrary to what we now think would be the case. So that's one of the reasons you have Ben Bernanke coming in and providing so much liquidity in the market. Now, has it helped? Well, certainly it's helped. I mean, it hasn't fixed the problem, but it certainly has helped. It's nice that Bernanke is in control of the Fed. He's a student of the Great Depression. He has a famous paper, 25-year-old paper, where he basically looks at what was happening in the Great Depression, looks at what some of the causes were. So I think that's one reason we're not going to go back to the Great Depression. Now, does that mean we won't have unemployment rates that potentially, go up, possibly maybe even hit double digit? Potentially, but that's not 25% unemployment. So we're not looking at Great Depression problems. Something else too. There were a couple programs that were undertaken during the Great Depression that try to help a little bit out. One was the Reconstruction Finance Company, which was founded in 1932, which basically made loans to banks on the basis of collateral. That could be something that could be done as well. That we make loans and we take collateral. Now that one of the things that the RFC was criticized for was eventually the next year it was made to publish the names of the banks it was lending money to. Okay, which seems like a very good thing in terms of transparency. We're going to, if you're going to borrow money from us, the taxpayer should know who you are. The problem is this was still before the FDIC was in place. So anytime you went to borrow money from the government, from the RFC, everybody knew that you were in trouble, and so that could potentially cause bank runs. So bankers realized this, and they didn't want to participate. So it thwarted the effectiveness of that program. We might want to be a little bit careful too, if we're talking about trying to put provisions in place to stop golden parachutes. If you put those in place, the same CEOs and executives that made decisions that got us to where we are now, they're still probably going to continue to look out for themselves, and they might not participate in programs if you're going to cut their golden parachutes. Is that something nice to hear? No. Is it fair? Of course not. But we have to be careful about what sort of programs. So this might be something we might want to consider as we're trying to design some sort of rescue plan as opposed to a bailout plan. Something else they did in the Great Depression the year later was they founded the Homeowners Loan Corporation, which basically bought out mortgages, refinanced mortgages from homeowners, and renegotiated it so they could pay it back. And at one time, it actually refinanced a million different mortgages and refinanced up to 20% of all owner-occupied homes that had mortgages on them, non-farm. Okay, so this is a huge amount of homes. It actually made money. Okay, the government actually made money on this situation. So, I mean, there are a few programs that they put in place then, later. Okay, it wasn't early on. They didn't do anything for a long period of time. So I guess that's the difference between now. They're being proactive now. They're doing something, and that's what's going to stop us from going to another Great Depression.
Thank you, and we'll have a chance to ask you about what suggestions you have for the upcoming bailout plan. The next question is to John. John, the question here is: insurance funds such as FDIC reserves are primarily, for individual events. When we have mass defaults, do we have sufficient funds? Can they handle? Maybe John or Paul can address that.
Well, my perspective is they're stronger now than they've been. They even had a period where they backed off on the assessments that they had to the banks. They've only recently started charging them again because they did have what they perceived to be sufficient reserves. So I don't have any current statistics for you on that, but the perspective's good.
Okay. Paul, you want to add something to that, or? Nope.
No, I mean, it's the FDIC is quite solid.
Okay, wonderful. Mike, I know this is very similar to the calls that you get. Should an individual investor get out of the market today? how much more the market will drop, how long, and it drops before it turns around. I'm writing everything down, so.
Whoever asked the question, you need to either talk to your financial advisor about your process. I can tell you that there are great companies out there making money, but everybody is being affected by this, even those great companies. This is about risk management. It's not about the stock market. Stock market is only a piece of your risk management. So is your bank account. So the issue here is that you really need to have a plan in place that really fits you, including all the emotion that goes with this. My crystal ball says that we're closer to the markets going up than it is for the markets to go down. But to give you a perspective, the S&P 500 has given you a negative 3+% over the last 5 years on a calendar basis, and a negative, I don't know, after yesterday, a negative 5% average per year over the last trailing 5 years. So what that says is that at some point in there, our economy is going to turn, confidence is going to come back. The fear factor right now is the hardest part in any bear market and any economic trend. But under the right circumstances, with the right deals, very smart investors are putting money to work. Now, if you could cut a deal like Warren Buffett did with Goldman Sachs, I think with a guarantee of $500 million cash flow a year, that's not a bad deal. If you could cut a deal in which you get to buy the stock at a discount, and if worst case you get to put it back at no less than a 10% loss, and there are no timelines on this, that gives you the ability to think long term. Great investors can think long term. They don't see themselves as speculators. They see themselves as the potential to buy an entire company. So for you to sit down with people who are your advisors, and why do people use advisors? There's only one reason. They don't have the time to do this themselves. I don't have time to go get a law degree. I don't have time to go get an accounting degree. I don't have time to go and get a banking, finance degree. I do what I do, and you do what you do. We all leverage ourselves. The issue here is you've got to have open and frank consultation. And it's not going to be perfect. We're in a very, very difficult time. Be communicative and say, this is how I'm feeling. If you're losing sleep at night, you probably need to make some changes in your portfolio.
Thank you, Mike.
Yep. Just one other thing, just sort of a flash of hope here. There's been a bear markets, if you define a bear market as a 20% decline in the market, there's been 5 periods of decline since 1980. The average bear market's 14 months long. That's peak to trough. The current bear market peaked, we're in a bear market now, the peak was about a year ago. So if things are not worse than average now, I suspect they are, they're not worse than average though, we're almost out of the bear market. Remember, same with recessions. Recessions end, the market tends to turn before the actual economy turns, sometimes up to 6 months before that. Things always look darkest right at the bottom of the bear market, and everybody's out of the market, and that's when the market stops going down once everybody gets out. So we've been through bear markets before, and we're going to get through this one.
Thank you. I appreciate it. Paul, the next question is for you. What recommendations or considerations would you have for individuals thinking about building a new home with the use of a mortgage in West Michigan?
Well, if you can get a mortgage, it's not a bad time. There's lots of houses available to buy. I'm not sure you need to buy, but there's lots of builders who have idle hands. So if you have access to the funds, I'm not sure that it's a bad time to do it. Trick is finding the funds.